What's going on, guys? My name is Jason and welcome back to the channel. If you haven't already, be sure to subscribe to the channel as it helps it out tremendously. That being said, in today's video, I'll be talking about mistakes most beginner investors make. I think one of the biggest misconceptions when it comes to investing is that it's only set for the rich, and that's far from the truth. Maybe 10 years ago that would be true, but nowadays it's so easy to get started. The barrier to entry has gotten so easy, you can even start off small, even with a couple $100s. So there's literally no excuse for you to get started today. The first mistake you can make is not taking advantage of group RRSPs or other employer retirement plans. So many people pass this up, and many employers will actually match your contributions. And that pretty much means you're getting free money, so why not? And some of the advantages to group RRSPs include low-cost mutual funds. And because you're a part of a group, fund management fees are typically lower compared to if you were to do it on your own. Competitive investment options. Group RRSPs can offer a broader range of investment options. And some options may even include that are only available to top-tier investors. Immediate tax savings. Now, depending on your tax bracket, you can save up to 40% on your taxes, and that can make a huge difference. Let's say you contributed $100, and that makes a $60 difference on your net pay, and that tax break simply comes off your paycheck. Regular automatic contributions. Now this makes investing so easy, you don't even have to remember when to invest because it does it automatically. With investing, many of us become emotional, and regular automatic contributions take that away. You also benefit from dollar cost averaging, which I'll touch on later on in the video. Lower minimum contribution limit. Most group plans let you make lower contributions compared to if you were to do it on your own. Financial advice. Financial advisors are assigned to each company, and you can definitely take advantage of this, especially when it comes to discussing your personal finance goals. The second mistake is thinking you will become rich quick. Investing can be very exciting, especially when you start seeing some profit. But many people who get started with investing expect results instantly. Investing is definitely not a short-term game, but it's more of a long-term game. It's very easy getting caught up by looking at others and trying to make money very quickly. Because nowadays, all you see online is gurus trying to help you make a quick buck. And all they're really doing is pretending and making it look like they made it overnight or very easily. Now, don't get me wrong, you can actually make money very quickly, but those profits will run out just as quick. You really have to train yourself to have discipline and the right mindset. And once you start seeing the power of compounding come to life, and soon you'll realize how powerful it is to stay in it for the long run. And if you see an opportunity that seems too good to be true, in most cases it is. And a lot of people go through this thing called FOMO, fear of missing out. So you shouldn't really get caught up on what others are doing. Instead, focus on yourself and try and get better. And if you're getting any type of value out of this video so far, be sure to give it a thumbs up so I know to make more videos like this in the future. And also be sure to subscribe and turn on the bell notification so you don't miss out on future uploads. The third mistake you can make is not diversifying your investment portfolio. Now, your investment strategy will obviously be different than someone else, but there's one thing that you should have in common with everyone else, and that's to diversify your investment portfolio. Because simply by putting your money into one area, you put yourself at a high risk. Now, you might do well for a little bit, but eventually it will catch up to you and go against you. Always be looking at different assets and in different sectors to park your money in order to protect yourself against any downturns. This will help your investment portfolio stay balanced. Now, you may want to look at a mixture of stocks, bonds, some real estate REITs, and others. Keep in mind, each person will have different goals and which sector they want to park their money. The fourth mistake you can do is not doing enough research when it comes to investing. This one is very important as it can make or break your investing portfolio. Nowadays, you hear all different types of opinions from articles, emails, and TV talking about which stocks are good and where you should invest your money. And while this information can actually be helpful while you're doing your research, be sure to also do your due diligence. Because in most cases, when people are talking about how great an investment or a stock it is, most of the time they're just hyping it up so they can take profit for themselves and then dump it. This is also known as a pump and dump strategy. And many beginner investors tend to fall for this because they don't do enough research. So don't just trust what you hear. Instead, take the time and do your own research so you don't fall victim of this. And last but not least, the fifth mistake you can make is trying to time the market. As we all know, the market fluctuates, and many financial experts will make their own predictions on where the market will be headed next. or when to buy and when to sell. And this can also be applied to other investing markets. And these so-called experts are typically wrong. Now, of course, when you're looking at a chart, you will notice different patterns and historical data, which can be helpful as well. But remember, that doesn't mean the market will do what you think it will. The biggest mistake as a beginner is trying to time when to buy, when to sell, or look for ways to quickly make some profit. This typically leads to you losing some, if not all of your money. Now, don't get me wrong, there are some successful people who day trade, but that comes from a lot of trial and error. Instead of hunting for the right time to enter or exit, you can also look at doing dollar cost averaging, which is a great way to make your money work for you. Simply, dollar cost averaging is when you're buying into the investment at different price points, rather than putting a large lump sum up front. And guys, with that being said, I hope you enjoyed today's video, and don't forget to give this video a like if you got any useful information from it. Also, be sure to subscribe and turn on the bell notification so you don't miss out on future videos. And just like that, I'll see you on the next one.